For millions of people, owning a home is a lifelong dream, a dream made possible for most through a financial tool called a mortgage. But what exactly is a mortgage, and how does it work? Today, we'll uncover the ins and outs of mortgages, diving into how they function in both the UK and the US, using relatable examples to bring the concept to life. A mortgage is essentially a loan specifically designed for buying property. Because most people don't have hundreds of thousands of pounds or dollars saved up, a mortgage allows them to borrow the majority of the purchase price from a lender, such as a bank or building society, while paying back the loan over many years. Here's the basic idea. You put down some of your own money up front, known as the deposit or down payment, and the lender covers the rest.
Hi, I'm Sarah. I found a small flat in London priced at £300,000. In the UK, a common deposit is 10%. That means I need to put down £30,000 of my own money and borrow the remaining £270,000.
Hey there, I'm James. I'm looking at a modest home in Los Angeles, priced at $500,000. In the US, down payments vary, but let's say I qualify for a 20% down payment. I need to save $100,000 and will borrow $400,000.
In both cases, Sarah and James are taking out a mortgage to cover the rest of the cost. But here's where the details begin to differ between the UK and the US. When you take out a mortgage, you agree to repay the lender in monthly installments over a set period, usually 25 or 30 years. Each payment has two parts. The principal. This is the amount you borrowed. The interest. This is what the lender charges for letting you borrow the money. Over time, your payments gradually reduce the amount you owe, but in the early years, most of your monthly payment goes toward interest. The interest rate on your mortgage can make a big difference in how much you pay over time. There are two main types of interest rates. First, we have fixed-rate mortgages. The interest stays the same for a set period, giving you predictable payments. Then, there are variable-rate mortgages. The interest can change, often based on market conditions. In the UK, Sarah opts for a 2-year fixed-rate mortgage at 5%. After 2 years, she'll need to remortgage, essentially shop around for a new deal or move to a variable rate. James, in the US, chooses a 30-year fixed-rate mortgage at 6%. Unlike Sarah, he doesn't need to remortgage. His interest rate stays the same for the entire term. Before lenders approve a mortgage, they carefully assess your financial situation. They'll look at 1. Your income, how much you earn annually. 2. Your credit score, a measure of how well you've managed debt in the past. 3. Your debt-to-income ratio, how much of your income goes toward existing debts. For Sarah, the lender in the UK uses a formula called an affordability assessment to ensure she can afford the monthly payments. For example, they might cap her loan at 4.5 times her annual salary. Lenders also evaluate credit score. A higher score could mean a lower interest rate, while a lower score might require him to pay for private mortgage insurance, or PMI, an additional cost to protect the lender. Mortgages can make homeownership achievable, but they come with challenges. For instance, what happens if interest rates rise? In the UK, Sarah's variable rate mortgage could lead to higher monthly payments after her fixed rate period ends. For James, while his rate is fixed, property taxes and insurance costs could still increase over time. Both also need to be mindful of early repayment charges. In the UK, paying off a mortgage too early during a fixed rate period might trigger hefty fees. In the US, some loans also come with prepayment penalties, though they're less common. Before taking out a mortgage, here are a few tips to keep in mind. 1. Save as much as you can for a deposit or down payment. A larger upfront payment can reduce your loan amount and monthly costs. 2. Shop around for the best interest rates and terms. A small difference in rates can save you thousands over the life of the loan. 3. Understand the fine print. Be aware of fees, penalties, and how changes in the market might impact you. 4. Plan for the future. Can you still afford the payments if your circumstances change? Mortgages can feel daunting, but with careful planning and the right knowledge, they're a pathway to achieving one of life's biggest goals, a place to call your own.